Jigar Mistry is co-founder of Buoyant Capital. He's joining us right now. Jigar, writes a weekly note which gets sent out at 3:30 precisely every Friday. And for 3 or 4 weeks now in his notes, Jigar, in that note and in our conversations here on the channel as well, has been advocating a bit of caution. Now, caution is what we have on our screens, Jigar. What do you make of it?
Good afternoon, Prashant. Yes, I think there, Nimesh did mention a few things, but if you look at it from a fundamental standpoint, there are a couple of things one needs to be wary of. The first one is that, demand recovery, one needs to look at it in the lockdown 2.0 has not been as severe as lockdown 1.0, right? So you're not going to see a return of the pent-up demand as fast and as strong as you have seen around the July, October sort of period last year. Secondly, inflation, may not be sort of as transient as what a lot of people sort of started believing. You look at across agri commodity prices, you need to take into account the cognizance of that into corporate margins as well. So the corporate profitability as you proceed going forward isn't likely to be as strong as what we have seen over the past couple of quarters, which has been fantastic, right? Like fourth quarter was among the most blockbuster quarters for Nifty and BSE 100 companies that we have witnessed. And third, clearly, is the behavioral aspects. Now, Nimesh again mentioned a few, but the ones we also track beyond that, and what you said, we have been writing about that, which thankfully CNBC also carries, is that the small and mid-cap outperformance vis-a-vis the larger indices, we wrote that about a couple of weeks back, was already at a level which has not been seen in the last 10 years or so. So 2008 was better, but since then, this is the largest level of 1 year outperformance by them. And again, today, we are going to write about how, the number of stocks that hit a 52-week high is today in the last, so you exclude the last 2 days, has been at the levels which is very close to top of the cycle rather than, the bottom or middle of the cycles. So, if you combine those and the frenzy that, your colleague also mentioned, you need to, be cognizant of the fact that not everything is in the buy zone. We agree that market entirely need not be very cheap for you to be positioned over the longer term. But, the sort of close your eyes and buy anything, buy any IPO, that sort of thing needs to be tapered down in quite a big fashion.
But Jigar, are we in that euphoria stage where even a bad IPO, for instance, can get lapped up by, 50 times in terms of oversubscription? Are we there yet? And, you said that, going by the data, the small cap outperformance vis-a-vis the mid caps or the number of stocks which are hitting a 52-week high, you're saying this is the most that we've seen in the last decade or so. But we all know that usually it doesn't end well. So what is your prognosis for the coming few months?
No, I think, on an overall basis, India is a reasonable place to stay invested even now. So you're looking at, the leverage for Indian corporates going down big time in the last 5 years or so. A lot of structural things have happened, starting from the banking cleanup to GST, etc., etc. So NBFC crisis came through and that cleaned up a lot of stuff. So it's not a bad place to stay invested. But again, that doesn't mean that we were actually among the first ones to argue back in July, August that small and mid caps are the ones that have not done well at all, even by historical standards. So since the cycle peaked in 2018 until middle of last year, the mid caps have corrected the most compared to the large caps. But I think that situation is reversed to quite an extent. So as an asset class, you played the recovery. Now the focus needs to go back to fundamentals of companies that you are evaluating. One can argue that, that should always have been the case. But when the tide is turning, every boat gets lifted with it. But now I think incrementally, or at least for the last month or so, we have been extremely cautious on the kind of stocks we are staying invested in. We are also have increased some amount of cash into the portfolio, looking to buy, if there were to be some sort of correction. But again, case to case basis, there are a lot of themes that we even currently even having raised the cash, we are still largely invested into the market. So a lot of themes to be sort of talking about, but this generic buy any mid-cap, buy any IPO, that needs to be tapered down.
Jigar, the market is down, and that also provides maybe idiosyncratic opportunities here and there. Anything you'd like to highlight?
Yes, Prashant. So a few things. One, see, the banking systems are ones which is seeing this sort of euphoria in bits and pieces, and then it is being tapered down. I think, lockdown 1 and 2 combined, the deterioration in asset quality is not as high as a lot of people are even expecting now. And the underperformance, which began in December 2019, has not fully corrected yet. Banking being a leverage play sort of is a two-way sword. It corrects a lot more and then it goes on and outperforms a lot more. I think in that space, ICICI Bank, SBI and Federal are the stocks that we own. We like them a lot. I think over the course of next 2 years or so, these banks can show significant improvement in terms of their earnings, their asset book, and which will get reflected into the stock prices. Then a few reopening themes also make a lot of sense. So unlike last time where people stocked up on discretionary plays, I think a lot more interest will go towards differing themes. People want to go out and eat and travel and sort of shop more, which they couldn't do the last time around. So within that space, we are invested in 3 or 4 stocks. IRCTC is one. United Spirits is another. ABFRL is the stock that we have discussed in the past that we like. And there is another smaller cap company called Pokarna, which exports granites and quartz. That is a company that we have added over the past year or so. Lastly, there needs to be some exposure to a strengthening sort of dollar theme. The dollar index has corrected. I think you did a show some time back as well. And in that space, rate may not be, the US Treasury rates might not be sort of increased anytime soon. But you will see some amount of dollar strengthening and some exposure to that is warranted. You might want to play it through commodity. You might want to play it through the IT companies. And the one stock or 2 stocks that we have liked in the past in this space is eClerx and FirstSource. I think we used to like Cyient as well. That still continues to be in our holding. So whether commodities or some IT plays, the large cap IT is something where we think there could be a lot more pressure in terms of margin and the growth might not be as strong. So mid cap IT remains a preferred pack. And some exposure sort of is warranted into a strengthening dollar theme as we go over the next year or so.
Pleasure talking to you, Jigar, always. IRCTC, United Spirits, ABFRL, a couple of chemical stocks and a bunch of others that you've highlighted now and earlier as well. Appreciate your time, Jigar, as always. Thanks very much. I think that brings us to the end of the show as well. We are down 138 points, which